I didn't know what to name it, and I wanted to talk about the macro market. So I went with Macro Bear, Hungry for Golden Lollipop with Uranium Center, because I wanted to touch on uranium and gold as well. But this is really a macro journey through Chartland. I am Nick Hodge. This is VRIC, obviously. It's May 2022. Mr. Alkin, how you doing? I run a company called Digest Publishing with a partner. I was previously with a large financial publisher for, 13 or some years, and helped them grow newsletters, launch divisions there, and then went out on my own in the fall of 2020, as many others did in the quote-unquote mass resignation. We have a free e-letter called Daily Profit Cycle, where we publish editorials on a daily basis about the entire market, all asset classes. And we also own Resource Stock Digest, which is a separate business that's pay to play. So we take money from companies to help them advertise, and we always fully disclose when we're recommending them or buying them ourselves, because our model, even on the publishing side, is to write about what we're doing with our own money, how we're navigating the capital markets, and we divide that up into risk levels. So Foundational Profits is my monthly macro positioning letter. It comes out every month. I've been writing that for about 10 years under various names, and recently, and definitely unfortunately with the passing of Mr. James Dines, I've been asked to continue writing the Dines letter under the banner of Foundational Profits. So anyone who was a Dines reader knows his staying power and how long he published his letter for, and the great calls that he made. I hope to do half as well as he did for half as long, and I'd be happy. This is a macro bear part of the talk. So before we get to bear market and stocks, let's talk about slowing growth in the economy. You had the yield curve invert, the 2s and 10s again earlier this year. Every time that's happened since the 1970s, you've had a recession that followed. Now, the inversion of the yield curve doesn't say when the recession is coming or what the duration of the recession is going to be. We just know that it is on the way. And so I think you can sort of feel that already, and we'll get into that in some of the slides already, but nonetheless, yield curve has inverted, so recession is coming. A recession is classically defined as 2 consecutive quarters of negative GDP growth, and you just had the first one come in at negative 1.4% for the first quarter of 2022, while you had major banks and the Fed saying that it wasn't going to be negative, and so you're already halfway to an official recession, and these comps are going to get harder. So obviously you see the spike for lockdowns, and then you see the spike up coming out of lockdowns. What we're comparing the economy to is coming out of a lockdown, and it can't compare, and the market discounts that growth because it's looking for rates of change, so we're slowing down relative to how fast the economy was growing coming out of lockdowns. The banks, like I say, blue chip consensus hasn't figured this out yet. They're still saying that Q2 GDP is going to come in at 3%. They're off the rocker. I mean, the Fed at least is starting to get a bit of a clue. They're starting to guide down. You can see how they're revising their estimates for Q2 GDP downward. They're now down below 2%. I would argue it's still going to come in closer to zero or negative to manifest that recession that I see coming. What makes a recession worse? Higher prices, inflation. And so now you're at the highest U.S. inflation rate in, honestly, longer than I've been alive, since 1982. So I haven't seen the inflation rate this high, and many people haven't either. But you've seen that sort of manifest in energy prices, and that just makes the coming recession worse because consumers are paying more for nearly everything, which you also know. And this is really the inflation starting to set in as far as how the consumer views it, right? So the consumer sentiment is now the worst it's been since 2011, coming out of the global financial crisis. And the buying conditions for durable goods are literally the worst they've ever been, the weakest on record. And so we're setting up here for a slowing growth period in just the economy I'm talking about. In the U.S., I haven't even gotten to the stock market yet. This is the stock market. This is that slowing growth starting to get sold down in the stock market, particularly in high growth names and tech stocks, with the NASDAQ down over 25% year to date. That's classic definition of a bear market. The NASDAQ is already in it, and I'll talk a little bit about why it could go down even further. The S&P to start the year is down some 16% on its way to a bear market, and you have earnings growth in the companies still contracting. So I would argue that earnings in the second quarter, like GDP in the second quarter, are going to be just as bad as they were in Q1. A couple of other things on the S&P is it could go down another 45% just to get to the March 2020 lows, the COVID lows, right? So tech stocks, despite being in a bear market already, down a quarter to start the year, could go down much further. They're just now getting back to their historic PE average. You look at the period from, call it 2008 to 2015, when they were significantly below their historical PE average. They're just now getting back to average now. Could go down much further. I'll pontificate for a second. Look, you've had trillions and trillions erased in market cap from large companies. I mean, Netflix has lost almost $100 billion in market cap. And those are big, established, major exchange companies, let alone the cryptos that are sending money to money heaven. I mean, you had Luna just collapse from $80, $100 a coin to literally zero in a matter of a couple of days. So things can go lower, things can go lower faster, things can go faster from things can go lower faster from oversold conditions. And a bit on market psychology, I guess, is we've been so conditioned to the punch bowl, the Fed put, whatever you want to call it, to buy the dip for so many years that now that that's inverted, it's not buy the dip anymore, it's sell the rip to position for the bear market or short the rip if you do that. That market psychology hasn't quite got in tune with that yet. That's my opinion. And so what is the bear hungry for? Well, so far the macro bear has been hungry for energy. It's one of the only sectors in the YTD column there that's up for the year. But, you know, that's not all market conditions driving that. There's not necessarily an oil shortage. There is significant geopolitical issues going on, the Russian war, for example. And that high oil price, I'm going to show you, can't last forever. In fact, oil has peaked in March, at least for the short term, because just like inflation exacerbates a coming recession, so does high oil prices. So the market can't have its oil and put it in its car too. Like if you're going to continue it at $105 oil and $5, $6, $9 a gallon gas here in Vancouver, then you're certainly going to go into a recession. And let's go down the list there a little bit more. The macro bear is hungry for consumer staples. Well, of course it is, because your kids still have to eat cereal. And then the third one there is utilities, which I would argue is a function of rates, the market discounting, the market reflecting that rates aren't going to go up as high as many people think they are, right? Because while utilities, yes, they're a traditionally defensive sector, they're also highly reliant or correlated to interest rates. And so if interest rates are going to keep screaming higher, like they have been, at least for the past month, I wouldn't think utilities would be doing as well as they have been. And then just right down to materials there, which is down 9.25%. This is where I'm going to start getting into gold. You know, materials contains a lot of things. There's chemicals and other things in there. But if you were to click that blue link on materials and drill down just into the metals and mining portion, you would see that it's flat for the year. And flat for the year, when the S&P is down 16%, is winning. It's what the bear is hungry for, at least one of the things for now. So we get softness recently in the past couple of weeks, right? You had gold go back down to around 1,800 where it started the year, really trying to hold support there. Gold stocks have broken down. The GDX and the GDXJ have broken down through, call it short-term resistance, and at least the GDXJ is consolidating down around $35. So this guy is asking me, am I still bullish on basically junior gold stocks? He is, but the 10-year is being a huge penis right now, he's saying. And I agree. So he showed me a chart of gold with an inverted interest rate chart saying that these interest rates going up are keeping a lid on gold stocks. And yeah, of course they are. When you have the 10-year yield in the U.S. go from, 1% to 3% in a couple of months, that puts a hard cap on gold stocks very, very fast. But remember what I was saying about utilities being up there. I think we're approaching a zenith, let's call it, at least in the short term for interest rates. More on that on a second. Actually, more on that right now. So the U.S. 10-year yield is bumping up against 3%. So I'm not much of a chart guy. I'm getting a little bit better. But if that goes up much higher, I'm not sure where it stops. It's not like there's a lot of resistance anywhere I see in that chart, at least not up until, I don't know, 8-9%. And so It's different than the late 1970s and 1980s in that the debt is much higher, and I'll get into that in a second. But what happens if that interest rate goes much higher is that things start to break, and everyone's trying to figure out what are those things that are going to break. Right now, it's sort of like the high-yield junk bond market. You're starting to see that break down a little bit as these interest rates go higher, and the poorer-rated people companies can't facilitate their debt at those higher interest rates. That's going to trickle down to other businesses, and in fact, the federal government if the interest rates continue to go up, which is why I think that green line is a relative cap on rates for the interim. And you can see I drilled into just the end of that chart here, year to date in 2022. And what did? They went right up to that green line that I showed you previously. And then they start to cool off because they hit that 3% and they're like, oh shit, we can't go up much higher than this because something is going to break. And so, like I say, if they do go up much higher than that, I think things will start to break in the economy. You'll see where this next crisis, metastasizes. It could be a credit crisis. You should know that the U.S. isn't the world. So if you look at interest rates in other places around the world, Japan, Europe, Germany, for example, they understand this better, at least right now in the current moment, than our Federal Reserve does. And their rates aren't as high. So gold makes more sense in other economies where interest rates don't have the bravado that the U.S. Fed is trying to convey right now. And this is why interest rates can't go much higher. At least not without major breakage. You've got total non-financial sector debt over $60 trillion. That's over 3 times U.S. GDP, and it's not slowing down anytime soon. So that's why raising rates now is different than when Volcker did it back in the day, because he was dealing with a much lower debt base. The current Federal Reserve is backed in a corner, and it's why you've got Jerome saying, out of this side of his mouth that he's going to raise rates, out of this side of his mouth saying that they're not going to be 3/4 point rates, because he can't commit to larger rates without something breaking. Gold. Gold does well after recessions, and if we're approaching recession, it might just be in a consolidation period, which is what I'm trying to show you in that chart. So you're having a nice consolidation right around 1800. It overshot, went to nearly record prices in 2020, but then near record prices again recently, and now it's consolidating down around the $1,800 level. I think if it holds support here, that you're in a pretty good place, especially because the higher cost portion of the producers and the marginal, I'm talking about the marginal producers, have an average all-in sustaining cost somewhere around $1,800. I mean, look at the mines there. Those are McEwen mines and then some other well-known mines. Red Chris is there. Their all-in sustaining costs are at the high end of the range over $2,400. And so you can't get gold going down much lower than the marginal cost of the highest producers, or else you have major problems within the gold industry. And so that's further support for my argument there at $1,800 gold. What does gold do last time the Fed got this itch? Well, the GDXJ tripled after the Fed raised rates in late 2015. And look at the chart preceding those rates. It almost looks like the chart coming down in here into this rate rise here. And so if we can maintain that consolidation of gold prices at 1,800, you're going to see a similar consolidation of GDXJ right here around $35, which is where it pulled back to. Honestly, I was bullish at $46 when it began, pulling back a month or so ago. But now you're really at consolidation and support at 35. I think this is a good opportunity to build a long-term position in GDXJ in the gold miners, but buy gold first, because gold stocks still go down in a recession, but gold provides you more protection. How many licks does it take to get to the center of this pop? I don't know. So U.S. rates have to come down or something will break. Global rates are lower. Gold is consolidating near the marginal cost of production, and their inputs are rising. So those marginal cost of production could go up. I mean, they're paying the same price for diesel that I'm putting in my truck, right? $4.50 a gallon. So that just is what it is. Let's talk about when to invest. Now, this is not stock performance. This is CapEx in sectors. The orange line is CapEx in the tech industry, and the blue line is CapEx in the commodity industry. If you read the fine print, the blue line is 2/3 S&P Energy and 1/3 S&P Metals and Mining. And you can see when it's time, it says right there on the chart, when it's time to sell commodities and buy tech, and inversely buy commodities and sell tech. You buy commodities when the investment, the CapEx, is extremely low. And I would say that the extremes you see on the far right of that chart are an argument to sell tech and buy commodities. What is the market doing right now? It's selling tech hard. Not buying commodities yet. More on that in 1 second. This is the NASDAQ chart from earlier. They're not cheap yet. This is a short-term commodities chart, and while it could be time to buy commodities for the long term, just like I was saying, it might be a good time to position long term for the GDXJ, in a very real way, you have a short-term peak in commodities. I picked oil and copper, but I could have just picked the Goldman Sachs Commodity Index, and it too would have peaked in March. And so you can't have commodities rising to new highs when you're facing the prospect of a hungry bear market. You could pick any number of commodities that were going up significantly higher last year, right? You remember all the tweets and the memes about lumber and aluminum and this and that? Well, you know, lumber's down hard. Aluminum is down as well. And so we're in the choppy part of this transition. And it is a transition. It's going to depend on these interest rates and the Fed, and that's sort of external factors that are beyond any of our control, but certainly are the things we're monitoring as inputs to see what to do next. If the bear is going to eat some gold when he comes out of his recession, then after that he's going to lick the center of the lollipop, which is going to be uranium. So if we're waiting to get through this recession for commodities to go back up, and gold is going to be buoyant during the recession, and then gold stocks after the recession, and we know that the CapEx in the commodities industry is so low that the commodities industry is about to shoot up and to the right, then you've got to position uranium near the center of that commodities industry for a couple of reasons. And they're all the macro bullish reasons for uranium. I mean, look at what oil is doing right now. I told you that the energy sector is the best performing sector of the year. Uranium is firmly in the energy sector. It's also a commodity, and it's also needed for this global energy transition that we have going on. So while you've got gold consolidating at 1,800, ready for a move potentially higher, the GDXJ consolidating at 35, ready for a move potentially higher on the backside of this macro bear, look what uranium prices have done. They're still up for the year. They're consolidating beautifully. Look, up off their lows down around $15 or $16, they ran to over 60, which still isn't the all-in sustaining costs of that commodity. And here you have them pulling back, consolidating beautifully at $45 a pound, getting ready for their next leg higher when the bear gets hungry after the recession. Hope that title made some sense. I'm Nick Hodge. Those are all my publications. Thank you for listening to what I had to say. I appreciate it.